this week's Best in Class, we want to welcome PIMCO's Mark Kiesel. He's a Bloomberg Best for his top-performing U.S. bond fund. Kiesel manages more than $6 billion within the PIMCO investment-grade corporate bond fund. He's also PIMCO's head of global corporate bond portfolio management. And Mark, good to have you back on the program. And it's interesting to have you back on the program after John just came out with this interview with Dan Arbess at Perella, who says, look, buy bonds, not stocks. And that's exactly what you say, of course, because you say that bonds are going to continue to outperform stocks, right?
Well, corporate bonds have done well. They've, over the last 3, 5, and 10 years, corporate bonds have delivered for investors 7 to 8% returns. At the same time, equities over that exact time frame have been negative. Corporate bonds have delivered that return with 1/3 the volatility of equities. Going forward, we think that corporate bonds can deliver, let's say, 5%, even 7% for high yield. Equities should deliver maybe the same, 5 to 6%.
Okay, so you're saying that the yield is pretty much the same, the volatility is less, and therefore you'd prefer corporate bonds. But some are saying, I'm getting a pretty good yield in the stock markets with these dividend-paying stocks, though.
Well, I think some stocks do make sense, particularly the large cap companies which have very good access to capital, which do pay stable income. I do think, however, with equities, you're really looking at earnings growth plus dividends. Dividends are 2%. Earnings growth is probably only 3 to 4%, consistent with nominal GDP growth. So, again, you're looking at that 5 to 6% outlook for equities. Corporate bonds can deliver that same returns with about 1/3 the volatility.
What do you make then, Mark, of some of these companies coming out then and because rates are so low, they're issuing all this debt in order to buy back the stocks? How does that undermine your view?
Well, we actively manage that risk. That certainly is increasing. Companies are sitting on $2 trillion of cash, significant amounts of cash. It's most apparent in pharmaceuticals, consumer staples, and technology companies. In fact, Microsoft 2 weeks ago issued over $4 billion.
Right, yes.
And increase their dividends. So that risk is certainly happening, but it's happening at companies where their equities have underperformed, where they're sitting on a lot of cash, where they're underlevered, and where they don't have attractive investment options. So they're giving that money back to shareholders. Okay. We monitor that, and we're underweight a lot of those companies, and we're overweight companies in industries like the banking sector, which is actually recapitalizing, and where you won't see LBOs, and where you'll actually see capital repair. So that the banking sector makes sense from a bondholder perspective. Okay. The technology and some of these other sectors make more sense from the equity perspective.
Okay, so going into banks then from the bond side of it. Thanks so much, Mark, for joining us. That was Mark Kiesel for our Best in Class.